Does this happen to you, where you see a demand or a support and you think of buying it, and it works in the beginning, the trade goes in your way, even getting close to a win, but then this happens? If this happens to you, pay close attention to this video because you're going to learn a simple trick to avoid getting trapped like this. So let's jump right into the charts. So let's come back to the most important part, and that is when the price is sitting right on the demand. Here, for example, we see this bearish candle that left a wick to the downside, almost breaking the demand down. But then the same candle quickly moved to the upside, managing to close higher, which is basically signaling a potential reversal, that itself being a reversal candle. What most traders would do now is that they're buying the top of the demand, being a logical entry level with a stop loss that makes sense, would be below the demand. Because as you know, demand zones are levels filled with buy orders from traders wanting to buy at a discount, and sell orders closing because some sellers are looking to take profit from this recent downside price action. Both of these actions increasing buying pressure, which as expected should drag the market higher, which is why buyers from this demand look to target either some higher level, like for example a candle closure, or a potential supply zone, or even target the swing high, the highest level from the recent price action, depending on their risk tolerance and so on. But we'll talk about how you think the exit targets, right in this video. Now, a smart way to avoid a bounce from the demand and then a liquidation to the downside, which would invalidate this demand, would be to move into a much lower time frame once the market has hit the high time frame demand. For example, we went from the 1-hour chart into the 5 minutes chart. And here what you want to see for a bullish scenario is for this downside action to end, with the market eventually forming a higher low, followed with a higher high. While the higher high should validate another demand zone, but internally, right here on this time frame, allowing us to enter with a buy position with a take profit that should be lower, but with a similar risk-reward setup as we would had if we traded the higher time frame demand. And it's here when we see this last bullish candle that's completely covering and closing above the last candle, looking like it's having large buying pressure, being a continuation candle. Now I assume you already know the difference between a continuation candle and a reversal candle, but I'll quickly tell you anyway so everyone understands. A bullish continuation candle is a large bullish candle, with a large candle body with small wicks. And this candle indicates that the upcoming candles are more likely to continue to push to the upside rather than pushing to the downside. And a reversal candle tells exactly the opposite, in case of a bullish candle that closes with a small body and large wicks, that indicates that the next candles have a higher probability to reverse the short-term trend towards the downside. So now you know for sure that this is a bullish continuation candle. We validate a low time frame demand zone inside the high time frame demand. And the demand is the last bearish candle before the upside impulse, being this candle, with wicks included. And it's from here where we can now look for a buy-long setup, on the top of this internal demand. Now a trick for the stop loss. If the internal demand is very close to the high time frame demand, it might be a better idea to place the stop loss below the high time frame demand. Thing that applies in this case, this makes the setup a little bit safer. The whole point of planning the setup this way is that since we're expected having at least a short-term reversal to the upside, because 2 reasons, we formed a demand, and we have a bullish continuation candle, so at least in the short term we have pretty high chances of bullish momentum. So even if the market would reject down from a resistance, or from a supply, we would be out of the position already. This way, even if both demands break down, it won't matter since we've taken profit from the supply. The order gets filled right at the next candle, and also gets retested one more time after, with a quick upwards push. So if you pay attention to the formations of the lows, it's forming constant higher lows and higher highs. And as this formation keeps going, it hits the take profit. Now here it's also quite interesting, because it invalidated the supply, breaking above it like it's nothing. So in this case, the market could have a rejection from the supplies from above. Could be from here, or from here, we don't know. But even if we would have targeted for higher, this setup is having a too high of a risk-reward, and unless you're extremely experienced, I wouldn't look for more than what we've targeted so far, which is basically taking profit at the first potential supply and nothing more. Let's jump into another market. On the S&P, we're on the 15 minutes chart, and by doing a quick analysis of this entire price action externally, we have an upwards push, later followed with a pullback to the downside. Pullback that ends on a higher low, later followed with a higher high. This is a simple uptrend, and you should know that a break of the past high in an uptrend is a bullish break of structure. And after a bullish break of structure, the most common movement is a pullback to the downside. This pullback is meant for the market to fill a demand zone, which, as we said earlier, the demand is the last bearish candle before the aggressive upside movement started to happen. And that's right here, taken from both wicks and the whole candle. And this being the 15 minutes time frame demand, that should fill and bounce to the upside once the market pulls back into it. At least that's what the theory says, but practically we might also face problems. That's why this planning strategy can be helpful, because you can quickly adapt to the market conditions. As the theory says, externally we expect a bounce from the demand, meant to break the past high into a new higher high. And the break of the past high is another break of structure, then another pullback is formed, which means that another demand is being validated, and so on. Now usually even if the demands would fail and become invalidated and broken to the downside, we can still use this small pullback for a buying setup to quickly get out of the trade before the downside pressure kicks in. Right here, the market moved exactly on the demand, with a wick, and quickly rejected back up. So because we have a proof of concept that this demand works, at least in the short term, we now zoom into a lower time frame and spot an opportunity there. From the 15 minutes, I usually go into the 1-minute chart, because the 5 minutes might be too close to the 15 minutes one. So this is the same price action seen inside the 1-minute chart. From the first look at it, we're coming from a massive downtrend, which is just a pullback of the higher time frame, straight into what it seems to be a push to the upside, which was caused by the market filling the demand. The break of the past internal high from here confirms the market structure shift, but internally, so it's right after breaking above this internal high when we have confirmed an uptrend, but an uptrend inside the 1-minute chart. Because on the 15 minutes one, we can still reverse into a downtrend. That would happen if the market would break below the higher time frame demand. But so far, this is a beautiful price action that shows a reversal to the upside. After a trend shift, we validate another demand, inside the higher time frame demand. And as you should know by now, it's the last downside candle before the upside movement started to happen. You can see it here. Also pay close attention to the type of candles. Here we have a reversal candle, just like I've said in the beginning, a candle with large wicks and small body. And right after that, we've had this pretty large bullish continuation candle. And what happened next, you can see it. Essentially, it respected the theory extremely well, and now we can plan the setup from this internal demand. Here, because this demand is far from the bottom of the higher time frame demand, we do not place the stop loss below the higher time frame demand, and instead a better idea for the placement would be below the internal demand. And for the take profit, we should look for potential supply zones, just in case the market enters into a downtrend, so we can exit the position before it might return to the downside. The first supply that we are afraid of is around this level, which is exactly where the market is sitting right now. This being a potential first internal supply, but on how bullish the market is looking right when entering into the supply, we might see it break out. And actually looks like we didn't so far, it actually respected, pushing the price down pretty aggressively. Now this validates another supply, and that's pretty much the same as the last one. And this one breaks to the upside. However, the position is still not filled, so we might need to look for another supply. Now this move leaves another supply for sure, being the last upside candle, right before the downside impulse. And this actually increases the risk-reward of the setup, even better. Now finally the order filled, and we're now really close to the stop loss. However, if we look strictly at the market structure formation, we are also very close to break the past high, which would reverse this trend to the upside in the short term. Here we go, the break happened, we now have massive buying pressure. Almost got stopped out again, but we got another bounce. And finally, that was it. And another market. With this one, we've touched all the major markets. We've started with S&P, then a currency pair, and now on commodities, on the gold market. Here, on the 30-minute time frame, we have an uptrend, characterized with higher lows and higher highs, a simple market structure. Then eventually we've got a push to the downside. Now with this push comes a break of the past higher low, turning it now into a lower low, from where you know that the first lower low during an uptrend is a market structure shift. It indicates that the bullish trend is coming to an end, and there are pretty high chances that now we've entered into a downtrend. Now, as I've said a lot of times, after any significant break, like a trend shift, the market often pulls back. And a pullback on a downtrend is represented with an upside price action. But it's called a pullback for a reason, because it's there mostly to fill a resistance or a supply, so new sellers can come into the market and continue the downtrend. But applying this concept of lowering timeframes, the moment we see the price filling the supply, we zoom into a lower timeframe. It can be any, but it just shouldn't be too close to the initial one. Now here, by analyzing the internal price action, we've got an uptrend, but then once again the same price pattern repeated. By that I mean that we broke below the low. And the same theory applies once again, just like before, but internally this time. So we identify a supply inside the higher timeframe supply, and the lower timeframe supply is the last bullish candle before the downside started to be more significant. And that's the opportunity for a sell position, with the stop loss below the internal supply, since it's far from the top of the larger timeframe supply. And for the take profit, now we look for demands as exit targets. The first and most important one that we're able to see is around this level. The position gets opened pretty fast, and now we just have patience. It's getting closer to the take profit, also having a bounce from this demand. It's why I mentioned why demand zones are great levels to use as exit targets from sell positions, because now if this demand respects and we would have targeted for a lower take profit, there would be high chances of getting stopped out. Now, if you're interested to shorten your time span in becoming profitable, from years of trial and error into 90 days, and most importantly, maintaining your profitability, make sure to check our materials on the link in the description and watch more of our videos.